Good morning, beautiful people of the internet, and welcome once more to our Sunday special live. We are not joined as always by many people today. We are joined as always by Piotr Rusinek, Adam Lawrence, we have Gianpaolo, and we have Imogen. Imogen, do you have something to say to us?
Go on, you can do it.
Pictures, like and subscribe.
Very good. Don't forget to like and subscribe. You heard it from Imogen. You can't argue with that. So what are we talking about today? I think Adam's supplement was pretty interesting this morning. I like the opening quote.
We have a special guest.
Yes, we do. We have a special guest, Gianpaolo.
Yes.
Good morning, all.
One Gianpaolo.
So Adam drafted me in on the basis that there was a spot to fill, and Adam and I have been talking for a while, and I actually mentioned to him about 10 days ago there was something interesting possibly to bring to the table. So here I am. I'll be on the panel, but I'll let you guys take the lead at the moment.
Nice one. Welcome to the chat. Adam, go ahead.
Supplement was 6,089 words this week, for which I never apologise, but in fairness, that's because I did line by line the exec summary of the budget, which deserved a bit of a takedown, really, on a Jeremy Hunt basis, I think. So I also put a couple of bits in there around the minor macro stuff that went on this week. Although I thought the timeline of events as I saw them this week was, Tuesday we had this minimum wage announcement, which was a bit of a surprise and was up fairly significantly. It was going to go to 11 quid an hour. Final decision was made to go to £11.44, a 9.8% increase, which is significant. It used to be the case years ago when the min wage was introduced that it was below the market clearing rate for labour. So let's say it was £4 an hour and most people in low skilled jobs were getting paid £5 an hour, let's say, right? So obviously, without going into the economic theory side of it, that doesn't have much of an impact. Now it's very much in the market, and already this year, when it raised to £10.42, where it is today, it was already impacting some public sector jobs because they're so poorly remunerated after so much austerity. So now we're right in the market with the lever, and the lever's being raised more than it ever has been before, more significantly than it ever has been before, the biggest absolute raise that there's been. Now, of course, some would say, good, people need to be paid correctly, and that's true. But of course, if we do the old reductio ad absurdum, as the Romans would have said, then we can all accept that if the minimum wage was £1,000 an hour, there might be some problems in that any businesses would go bust. So there is obviously self-evidently a point at which it starts to become problematic for employers. Hunt referenced 2.7 million people who are employed at minimum wage. But of course, there are people who are only just above the minimum, but below 11.44 at the moment, and a whole raft of people who are pretty much pegged to minimum or have a certain premium above minimum who will also benefit significantly from that rise. Dichotomous, really, from the landlord perspective, because on one side, I would argue inflationary, and this money's going to go out into the economy straight away. And if we think we've conquered the inflation beast, we're way too early to be making judgments like that. 1 month below 5%, and we're out spraying around 10% wage rises across the board. That doesn't make a lot of sense. And then, apart from anything else, on the other side of the coin, renters will be able to afford more in terms of rent rises, which are inevitably coming down the pipe, as we've been talking about as well for many months now. And obviously there have already been many rent rises, but there are going to be some more, and that's going to provide the fuel for those rent rises to be around about affordable. So on that side of things, landlords should be happy. But if it is inflationary, it keeps rates higher for longer, I don't think that does necessarily help landlords. Although you could argue maybe it does help them a little bit, because it keeps the competition much lower, because there won't be anywhere near as many people taking out buy-to-let mortgages and entering into the buy-to-let market to provide competitive units at a competitive price. That went alongside the triple lock, which kicks in at an insane 8.5% this year due to the third level of the guarantee, which is average earnings. I'm not a big fan of the triple lock. Won't be a popular thing to say, I'm sure, but I'm not a big fan. It's fiscally irresponsible, especially at a time like this. And ultimately, I don't really see why pensions need to go up at the highest of wages and also inflation and also other benefits. I don't see why. There's no good reason for it. It's the wrong money going to the wrong part of society that generally has got more money. The Conservatives would argue they've taken 200,000 people out of poverty in retirement since they've been elected in 2010. I would argue that actually that's mostly been done by the market, realistically, rather than what the Conservatives have done, because they've also taken 1 million odd children out of poverty, but the other side would argue they haven't done enough on that front. So my issue with the triple lock is at times like this, it's ridiculous and it's jocular and it can't be afforded ad infinitum. There is a point in the future where the nettle will need to be grasped, and if it isn't grasped, there won't be a pension system anymore. It needs sorting. It will need a crossbench solution without a shadow of a doubt. There's no two ways about it. As far as the particularly relevant property bits went, the big one, which made the exec summary as well, was the local housing allowance, or LHA. That was frozen from 2014 as part of the austerity campaign, and then was brought back to the market 30th percentile. So just a quick explanation of that. If you had 100 rental houses and they were ordered from the cheapest to the most expensive in terms of their rent, then the 30th percentile should be able to afford the first 30 of them in order. It wouldn't be able to afford the next 70. Used to be the 50th percentile, been the 30th for some time, but been frozen. Now, April 2020's rates were set in January 2020, and rents have moved on an enormous amount since then, at least 25% at this point. So for this week's supplement, I provided a map that Savills had put together that was what percentage of on the market properties on Rightmove could the LHA afford. And most of the map is deep blood red, which is fewer than 2%. Fewer than 2% of new. So the system was absolutely broken. Now, I'm a little bit cynical, as you know, and I thought that what I've been seeing over the past few months is providers and the LHA pegging system completely break down. You know, you cannot afford or entertain giving a property to a provider at the LHA rate. It's only something you can afford to do if you're unencumbered and particularly altruistic. That is it at the moment. So what's happened, the reactive system in the past few months, is that people have started offering 35% above the LHA rate. And I dare say that what are you a fish? So I dare say what people will have observed in the Treasury is that if instead they unfreeze it, then that will be cheaper than the 35% premium and all the rest of it, because they're losing control of the system. I wasn't sure they were going to do it. Other people were quite convinced it was going to happen, and that's a good thing. I'm personally surprised they didn't take it down a couple of pegs to the 25th percentile or even the 20th percentile, because that would be very much a conservative ideological sort of play, but they didn't. So they're keeping 30% of, and bear in mind, it will be January 2024's rents that sets the April 2024 precedent, which will run till at least April 2025. So if we threw a dart at 8% rental increases across the board next year, then by January 25, we'll already be 8% ahead. And so the 30th percentile will have tracked back again quite a lot anyway. So this is another symptom of inflationary times, and there's not really a lot that you can do about that. Reflecting on the speech in general and the whole piece, really, it does look a bit of a mess, because I did say in the supplement there was one point where I just exclaimed "liar" at the top of my voice in the office at something that Hunt said, and the reason was trying to pretend that people would be better off at any stage. Now, it's true to say they were better off at the end of Wednesday than they were at the beginning of Wednesday. That much is true. But the freezing of all of the bands of income tax, the personal allowance freezing, the 50k higher rate freezing, the higher additional rate freezing, everything else, people are organically being pushed into these tax bands. And in really simple terms, by the time we get to the time where 2028, 29 is the forecast end period, and that's when they can unfreeze the bans, so they say. Obviously, this would also presume they were still in power, which looks unlikely at this time. But if we get there, there's 20 billion in tax saving for working people. There's also 90 billion more in tax revenue by freezing those thresholds. And that's if you believe the government forecast for lower inflation. And as I think everybody who's listening to this knows, I'm still above where their forecasts are for the inflation period. So I believe that tax receipt will be even greater. Now, there's a couple of more interesting bits that have come out in terms of the analysis. One of them is that savings have actually brought in more tax receipts than anyone was expecting, because savings were not, if you think about your average mortgage, the way we do it in the UK, a lot of people are on a 5-year fixed rate, especially these days. The 2-year stress test has been too problematic, and so they're on a 5-year fixed rate. That's not the case with savings, because savings interest rates were decimated so badly. People were actually more on maybe a 1-year bond, or they've certainly been on 1-year bonds more recently because of the inverted yield curve. So they've been getting higher rates in 1-year bonds. And I know this isn't something that the general public particularly can get their head around. So I think if most people see a high rate on a 1 or a 2-year and a lower rate on a 5-year, they're going to jump into the 1 or the 2-year savings account. Although obviously people like Martin Lewis do their bit for educating people. But before the rates and the bond yields started rising, there was no real premium on being involved in a 5-year account anyway. These accounts were down to offering 0.8% per year for 5 years. People weren't locking the money up because it wasn't worth it. So as the rates have moved upwards, those savings have started generating money again, which has generated tax. So actually that's provided receipts before the drop-off of the mortgages, where people have been and were locked into the 5-year cycle, if that makes sense. So positive news in general around all of that, especially for the Treasury, who, bear in mind, even when I know I've seen some 6% accounts, they're not around anymore, but they were around maybe 3 or 4 months ago when the rates were really high. That's all well and good. But of course, if you're a 40% taxpayer, you're still paying income tax when you go past your £500 generous interest allowance for the year. So, and again, another threshold that's frozen. So lots of fresh tax receipts being generated, which was positive. But I came to one other conclusion as well, because I've started to see, obviously we're getting into Christmas is coming and we'll be in the new year, and everything will be about when's the election going to be called. There's no two ways about it. Now, this obviously depends on different geopolitical tensions and what's going on and where the next crisis is. The media vultures can have their feeding frenzy on, but generally we're going to be speculating about when the next election is. And actually, the way that people generally look at the world, although they'll be worse off than they were in 2019, people remember, they suffer from what's called recency bias, right? So they'll remember, partially a lot of us have put the pandemic out of our heads a little bit. Some of that is psychologically protecting ourselves, because there's definitely a PTSD opportunity for the whole of the general public there, let's face it. But 21 and 22 have not been good years for people as a general rule, especially the back end of 21 and the whole of 22. And 23 won't have been a great year either. This budget will improve working people's fate compared to 22 and the end of 21. So with that in mind, I wonder if they might just get a bit more credit and a bit more wind in the sails than anybody is giving them credit for at the moment. And I've said, and I should be clear, based on the prices in the market at the moment, because Labour are a heavy odds-on favourite for an overall majority, if I was betting, I'd be betting no overall majority at the moment. And I can see a coalition-style solution potentially being needed, because Starmer's strategy is to go out and not say too much and try not to win too many votes. He's maybe happily accidentally knocked off a few of the far left of the party with his stance on Israel and Palestine. That might be part of his strategy with that, or it might just be that he is a kind of middle of the road style character and is stepping more and more into the shoes of Blair as the days go on. There might be some truth in that. Now, one thing I left out this week, because there was already so much, was also the immigration numbers. So we had an interesting net migration figure come out for last year now of 745,000, which was a massive revision upwards on the 606,000 we already had, right? And now we're down from that figure this year, especially if you're a supporter of the Tories. We might have seen the peak, and we're down to a mere 675,000 odd. Which is still blowing all numbers from previous years way out the water. Now, you don't hear much sensible commentary around this because it's a highly charged issue that people have significant, ideological viewpoints on, apart from anything else. But first of all, you have to bear in mind how many have come through the BNO scheme, the Hong Kong scheme. We're approaching 300,000 through that scheme now. Average net assets of £350,000 a person. The economic argument for anybody who doesn't know it in terms of the data around immigration is, immigrants from the EU, generally speaking, take less time to become net positives for the country. It costs of money in the first few years, and then it pays itself back. And if you looked at it with the concept of what we call in business customer lifetime value, the average immigrant is adding money to the British economy, right? The data's quite clear on that. If they come from outside the EU, it takes longer. One could perhaps speculate that perhaps they're less likely to have a grasp of the English language, maybe, or a perfect grasp of the English language. I don't know what the other reasons might be. Perhaps they're starting from a poorer base. I'm not sure, but it takes longer, but they're still net positive for the economy. However, in the year that they enter the country, they are net negative. And that's what a lot of the negative anti-immigration rhetoric focuses around. I doubt you could say that for the Hong Kong immigrants who've come through the BNO scheme, who are bringing the net assets with them that they're bringing on average over £100 billion into the UK economy, which obviously generates tax just by being here. So in many ways, a phenomenally positive, economically positive move. Now, of course, it isn't just about economics. And again, we could use back to my reductio ad absurdum. Would we all agree 50 million immigrants a year would be too many? Yes, we would. So we know that there has to be some kind of breaking point, some kind of concept of sensible immigration. And of course, if there is a net negative in year one, then bringing many, many more in obviously also weighs down on the finances in year one. And just because you can make positive investment decisions in a country or in a business doesn't mean you can do everything you have in front of you, because you'll run out of money apart from anything else. So there is an economic balance to be factored in there. But of course, the problems in terms of lack of education, I mean, the biggest mess of the autumn statement was he mentions in the summary 5 priorities, which are new priorities now, because we're forgetting about the old ones that might not have gone so well and all the rest of it. We've got 5 new priorities now. And the 5th one is world-class education. And there wasn't a single piece in the budget that made the summary that did anything for education in any way, shape or form, apart from 2 billion a year extra, probably in real terms, although it wasn't clear in the speech. So I'm cautious about necessarily nailing that to the mast, but he made out like it was in real terms. 2 billion a year for education. Now that is 0.1% of GDP extra. And obviously that's not necessarily going to touch the sides. Our education budget is maybe 20% below countries that are achieving better results than we are, around about that figure, as a percentage of GDP, much higher than the US, but I don't think many people would look to the US for its phenomenal education system apart from anything else. Now, of course, we have a phenomenal reputation for higher level education, university level, some of the greatest universities in the world, magnificent reputational situation. But what are they doing from a business perspective? As a rule, they're bringing in more and more students from abroad because they don't have the fees cap on those students. So from a business perspective, it makes massive sense. And also, people from other countries want to come to the UK because of the reputation, because of the language that we speak, because it's the language of business, and lots of other, good and worthwhile reasons. And really, we've had a very poor visa system since Theresa May was Home Secretary. around making the most of our. Luckily, I would say people like Piotr hung around, but actually now he lives in Lisbon now, so maybe he didn't. But I mean, he hung around for a bit, and it was great to have him. And maybe he'll be back one day. You know, maybe he'll be back. But
I do come every month. Contribute.
Exactly. So it adds to the GDP, especially if you go out drinking. I've heard you two. Then it adds to the GDP. But that's all good. The other probably property relevant bit that made the summary anyway was the business rates freeze for retail, hospitality and leisure, which is positive news because it's overall been a tough few years. But investment wise, it's still very difficult. The super deduction, as it was when Rishi was still in number 11, has then become a permanent deduction of capital allowances. So at simple terms, if a business invests some money in some new plant or machinery or something that it could have expensed against profits in the first place, the whole of that will be written down in year one. Now, there's some really big advantages to that because with the right sort of leasing structure, you can lease something, but write the whole thing down in year one, apart from anything else. So it's very powerful from a tax planning perspective. And that encourages business investment, which Hunt himself does admit has been lower than anybody in the G7 for some years, basically since the financial crisis. And the results of that have been lower productivity apart from anything else. So what I liked about the budget, to be clear, was he was very surgical, and he is quite surgical with working with the Office for Budgetary Responsibility to say, this is going to add 0.2% to the GDP. This is going to add 0.1%. This is going to add 0.3%. And overall, there's over 100 billion of future GDP in there that should persist year on year, which would give you more money to put into the health service and education, which they know needs to be done. They're just doing it very, very slowly. And they're only doing it because they're at the centre of the party rather than the right of the party, although some people are often scratching their heads about which box you should put Sunak in. But people are saying April elections. I'm sticking with September because I think these April rises will have had a bit of time to kick in, and I think that they will be able to feel the benefit. And I'm not saying there's necessarily going to be a feel-good factor, but barring oil spiking up massively, Putin doing something else kicking off in the Middle East, something else happening that we can't see, we should feel better in September than we feel today as a nation. And that's the best chance they've got. And that's more than enough time. It was a long one. That was a long soliloquy. That's enough. But back over to you guys for commentary.
Can I interject quickly at this point? Adam, just looking quickly on the bookies market, the period in which the likeliest trimester for the election shows October to December, which I would say the city has been in agreement towards for the last few months. So that sounds reasonable. But I got a question for you. Would you say that this budget is a fighting budget from the Tories, as in they're thinking we may still have a chance, let's do the best we can to improve our chances, or is a budget like this election is gone, don't particularly care, let's just do something?
That's a great question, GP. And I think I had a couple of things to say about there's a bit of a conspiracy theory that started that basically they know they've lost and therefore they're shipping a pup to Rachel Reeves because she can't cut back some of these relatively inflationary things that they've done. It's not going to be an option for her, right? Now, I don't think that's the case. I think they've put their best foot forward. They've found 25, 30 billion more than they thought they would, purely because of inflation and the freezing of the bands. And remember, the March budget was based on the OBR forecasts that inflation would be 1.8% by the end of this year, at which point I termed them the office of the bloody ridiculous, because there's no way that was happening. So because of that extra inflation this year, they've got all these extra tax receipts. I looked up the people who form part of the OBR, the eminent professors, and just thought, where are you getting your forecasts from? Because they're just utter nonsense. But they weren't good at forecasting in periods like this where there's been significant disruption, whereas it was relatively easy for people like me, I think, to see what was probably going to happen, which is what's ended up playing out, you know. So I think they put their best foot forward. He definitely hasn't given up on them winning the next election. And stranger things, and if you think they're only if Starmer's only 20, if they would only have a 20-seat majority based on some of the most recent polling, it's hardly a landslide victory, and it's definitely not 1997. So Labour, I think, are going to have to change from don't say too much, Keir, don't upset anyone, because you're going to get into the debate season and someone's going to go, well, what's a woman then? Go on, Rishi, because Rishi's already taken his stance on stuff like that, and Keir's going to go, and he's not going to look very good because he already cut. Well, 99% of the time it means this. It's like you just look weak in those sorts of positions, and that's easier for a Conservative than it is for a Labour leader to take the positions that people would expect on. And those issues do matter because they are, whilst they don't affect perhaps 1 in 10,000 of the population, if the data's right, it's certainly, again, another emotionally charged issue that people want to hear things on. So I think best foot forward. He's spent pretty much everything he can whilst being within the confines of being a fiscal Conservative. So last time out, and when he did what will probably become known as the repair budget of autumn 2022, when he's trying to sweep up after Truss and Kwarteng, he was very, very mean. He really kept things very tight. He's given away as much as he can. He's given it to working people. The cut in national insurance is clever because that's only paid by working age people, right? So it's not like cutting income tax, because at the end of the day, landlords who are personal name landlords pay income tax. They don't pay national insurance, right? The savings, remember what I was saying about the savings and how much the receipts have gone up in terms of the savings? They don't pay national insurance on savings income, right? All the people who've got the money in the bank or the building society. It's only the working people. So that is traditional, tried and tested, clear-cut Tory methodology to be able to counter offensive for when Labour say they're the party of the working person. I think they've also, though, possibly slightly misjudged, although I'm not clear because I haven't done as much work as one would like on the issue. Most of the pay deals that have been done this year have covered the next 2 years, right? So apart from the train drivers, who obviously are still on strike, I think that's pretty much the last piece of the public sector related workers to be on strike. So lots of people have accepted 5% this year and 5% next year based on the fact that inflation will be conquered by then. Look at these forecasts. But now it's not going to be. And the minimum wage is up 10%. So if I'm getting 5 and 5, well, we can't renegotiate in 2024 because we've signed that deal. So we're then going to renegotiate in 2025, which they can take on with a tough stance in a new election or leave that for the Labour Party to have another problem with. And either way, that's a little bit of a win-win for them. But I'm not sure there won't still be. It looks like Mick Lynch and his pals might have outsmarted them a little bit because they still haven't done a deal. And they're now going to be looking at this stuff going, oh, rightio. Okay, what are we accepting for the train drivers then, folks? And that might slightly scupper things, but it'll be interesting to see how they deal with them. But no, I don't think they've shipped them a pup. I don't think they've given up. And actually, I do feel on the back of it, but remember, I'm only looking through the economic lens. Of course, people hate the Tories and will never forgive them for what happened in COVID, for example, right? Of course, there are other issues that come into it. But if it's down to it's the economy, stupid, this is some of the best stuff within the confines of the greatest pickpocketing in history with the freezing of the tax bands, right? Within the confines of that, he's done as well as he can to try and win the election.
Guys, one thing that I saw in terms of property instead, rather than the economy, there's a consultation that has been open, isn't there, about splitting houses in 2 flats under PD. Did you guys see that?
Yeah, that was didn't make the summary, but obviously it was in the speech. Yeah.
I'm not the best person to discuss this. You are more property than me, all three of you, but I think it's worth expanding for the audience because it's quite interesting.
Well, I think the guys can probably give us a good London viewpoint first of all, and then I'll talk a bit about the provinces, maybe.
Yeah, sounds good. I think everything will be really depending on the details of that whole thing, because like with every PD, there's a lot of excitement when it comes up, and the consultation is being basically published. But then it's all about the minute details of what could be possible and what kind of hoops someone will need to jump through. in terms of values, I think in London, most of the time it does make sense to convert a house into 2 flats. Most of the time, because there are some areas where houses are just so much more valuable, and it will remain like this. Yeah, before getting excited, I'll wait for the details.
I think that's pretty fair. I think the it's to me, it just speaks to the poor state of the housing strategy, that this is kind of almost the last roll of the dice. How do we desperately create more units? It's like, but again, we're asking ourselves the wrong question. What sort of units do we need to be creating? That's the right question. So if these were going to create 1 and 2 beds for social housing, for example, if you're in a lower value area, that might well favour local authorities who need delivery of units like that. It might help. But if you're going to take the 3-bed semi or the 3-bed terrace out of the market near a school, you know, family homes are the biggest shortage of them all. They're not being built. They don't stack up to be built, generally speaking. We've got enough 1-bedroom flats, certainly in city centres and the likes. There's too many. Just go on Rightmove and plug in 1-bed flat on the market for sale, and you'll see how many of them there are. So this really doesn't help the housing mix, and it just strikes me as a bit of it's just one more desperation play for how do we tap into what we've already got. Financially, will it stack up in some areas? Absolutely, it definitely will. Will it maybe bring some empty homes back into use? I don't really see an argument as to why it really will, to be honest. But I mean, upsides why I almost, when I heard the announcement, I thought, I wonder if there'll be Article 4 on that even before it comes in some London boroughs, apart from anything. But and of course, is it going to include minimum space standards? Will be a big part of the consult, because they learned their lesson on that one when they enshrined office to resi back in 14, 15, didn't they?
Then there will be questions about parking and all kind of things. And do you need to provide parking? Will those flats have rights for getting the parking permits for the street? There'll be so many things. You raised a good point about the housing being like needed and the bigger flats or bigger houses being needed. Because when you convert a typical 3-bedroom house into 2 flats, you might at best get 2 small 2-bedroom flats, but most likely there'll be like generous size 1 bed,
or maybe a 1 and a 2. Yeah, maybe a 1 and a 2. Yeah.
I mean, if you think about this in the recent history and build a picture around what you've been saying, Adam, is, you know, they brought out they extended the PD and the PD rights for commercial conversion and office conversions, right? So it's taking existing stock and trying to increase the habitable square footage for the population and growth, which isn't, you know, recent numbers on that look scary as well, right? And then they were like, right, well, we've got all these blocks of flats. What's the harm in sticking an additional floor or 2 on top of those? They're born the airspace rights, right? And now you're seeing this, let's take existing family housing type stock and turn them into flats. So they're giving all of these considerations and all these benefits, when what they should really be doing is they should be laying out plans for developers to be doing what developers do and build from the ground up. But they won't do, and it's difficult to do that in a London metropolitan zone, because not only do you have the sill and the 106, you then have the mayoral sill, and all the other things that come with it. Now, should a developer who's building 100 flats also build a playground and put money towards refurbishing a dentist and a doctor's surgery? The answer is yes. Yeah, you should be doing something like that, right? Should you be building a new roundabout or putting money towards that? Well, yeah, if it increases the flow of traffic and blah, blah, yeah, all of those kind of things are good. But in general, should you just be playing tooth and nail and making every site that you look at completely unviable? No, you shouldn't be putting them in a position to do that. I mean, we're in an environment where during lockdown, or the 2 lockdowns, more developers went bankrupt and bust then than they did in the previous 20 years. And the previous 20 years were not the easiest 20 years for building housing stock in the first place.
Couple of ropey ones in there for the developers, as I recall, Jay. Yeah.
The amount of sites that were just stuck.
Well, I think it's a really interesting point, especially around SIL and 106, because they're poorly, it's everyday parlance for us, but they're poorly understood by the general public, which I think is one of the reasons why they're so anti new development. And I think there needs to be more transparency and more public education around SIL and 106, and also more directives as to how that money does need to be spent. And that would, I think that would help. But at the moment, you need to look at it to unlock some. I mean, look at John Lewis is a fabulous example of bringing together some of the stuff that the points that you very rightly raised. They couldn't make it work, even though some of their stores are in areas at, what are they going to be, 5,000 a metre or onwards in terms of their end value for a flat, and they still can't make it stack up. They can't make it stack up. So I'm not saying that, Kensington needs more flats on top of John Lewis or whatever it is, but there will be areas of the country where it would be useful to have that sort of building. And I think because development is so poorly misunderstood, and everyone just immediately takes this viewpoint that, well, all these developers, they've got all this money. And it's like, well, I've known lots of developers who've got the developers who are multi-generational, been in it for a long time, have got land banks and stuff like that. Sure thing. But they're still not going to do a development that makes them no profit whatsoever when they could just sit and wait and sell the land in the future. It doesn't make sense. So if you're going to rely nearly completely on the market, you need to understand the market, and then you need to incentivize the market. I mean, I know some poorer areas of the country where the local authority will sell a building for £1 and give a developer a grant to develop it because it's the only way to get it done. Well, if that's what we need to be looking at, why don't we spend some more time and resources and effort on that scheme and encourage the SME developers in? There's loads of sites that we would look at, right, as people who wouldn't build it ourselves. And then I say this to builder developers who I'm consulting for all the time. I'm like, just because you can deliver that at 1,200 a metre and it costs me £2,000 a metre doesn't mean you should do that deal if it's not a good deal. Because all you're going to do is work for your money and take all that risk. You need something that's a deal, and then you need to deliver it cheaply, and that's when you will break through and really make it as a property developer. Easy to say, not easy to do, right? But there's these, as soon as someone comes anywhere near the reality of the cost per square metre now of delivery versus where the public sector theoretical figures are at, again, just like the LHA rate, there's a giant disconnect.
Well, I've got two stories to share. One story is there's a local Facebook group for the area in the East Midlands. And there's a bingo hall that has been empty for, 10 years, longer. It's right in the centre of the high street. And the high street, bless it, is dying a death. There are more beauty salons and barbers on that high street than there are anything else, apart from 2 cafes and some other things. But there are 2 arcades, or if you're a snake oil salesman, there are 2 CMOs, right? There are 2 arcades where there's multiple little units, and they have been mainly vacant for, well, I've been here 3 years, but longer. And they're trying to look at this big bingo hall, and they're like, well, we can't let it be turned into flats, so let's try and turn it into like a big arcade and things like that. Well, why would people go in there and not in the 2 existing arcades? And on top of that, why are you happy with there being homeless people in a wealthy Western European country, which there shouldn't be homelessness? Just, it's ridiculous that it exists in a country that should be doing quite so well. But why are you so against more flats? Why are you against having somewhere for your children and grandchildren to be able to move out of your hobble of a two-story house? Where are you going to put all these people? they need somewhere to go. So, and then they're like, well, they'll put another HMO up. Okay, they're putting more places for people to live where they can afford a cheaper rent, a cheaper way of living. Like, what have you got against these things? What have you got against people having a home, somewhere that they can live, where they have to be able to match their affordability? Because even where I am now, the difference between a 2-bedroom terrace-style cottage house and a 2-bedroom flat is still £50,000. So you need them. Because unfortunately, there isn't a local train line that can get you into London in 45 minutes. There's 2 buses. So, and there isn't a great deal of business and commerce happening in this local area. The last bit of business and commerce was making shoes for World War II. But no one's living off of the big money that created. Not that it made.
Sounds like a load of cobblers, mate. Sorry.
But I'm reading these things and I make these comments, and then people just come out and call me they call me other names, not worth sharing on a Sunday morning. But it's kind of like, what's wrong with you? Why you want all of these commercial? There's a big place called the Lakes near here, and it's got a Debenhams, it's got a Wagamama's, it's got everything that you'd expect to find in anywhere. And they're all upset that it's there because it's taking all of the business and trade from the high street. Well, the high street's evolving, it's changing, but the parts that don't evolve and don't change need repurposing. And in 100 years' time, when the commercial is needed, the cheap residential that's there will be converted back, because that's what it does. It cycles. It always does. No one wants to hear that. As you mentioned on the call so far.
I think Grafton needs a new mayor.
Yeah, very, very short stories. But they don't like that. Story number 2. I was talking to somebody referred over to me who wanted to sell their mixed-use building. Now, it's in a really nice area. The building itself is really centrally located. It's really nice. Last year, it was valued at about 1.4 million. Had 80-odd thousand pounds worth of income. So I'm talking to the chap, and he's like, well, I'm looking to sell it. I want to take the money from this asset. I want to pay off its mortgage, which is low, and I want to clear the mortgage on 2 other properties I have, and I just want income coming in without any mortgage, retirement, blah, 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 blah. Well, that's a great idea. A lot of people are doing that for whatever reason. I said, but to sell this, I think if we put it into auction for X, we would expect it to sell for Y. Now, Y is quite drastically lower than the 1.4. And I said to him, I said, look, you seem upset. What was your expectation? He goes, oh, well, I got that valuation a year ago and property prices moved. I think I'm looking for 1.6 million. I said, you want someone to pay for your property on a 5% yield. You want them to pick up on a 5% yield. There's no mortgage product out there that's going to cover the cost of that income. Not one. And if there is one, once you've landlord insuranced it and paid your tax, this is a negative cash flowing asset. Well, who's picking up? And his response to me was, cash buyers will buy it. I said, you're absolutely right. A cash buyer would buy this. But no cash buyer is deploying funds to get a 5% yield. Not a single one. Not a single one that actually has a value to their cash that they have in store. Not a single one. And I said, the cash buyers that I know, I could introduce you to 2 or 3 that are actually good operators. And that's a very short percentage of the cash buyers. 2 or 3 that are really, really good cash buyers. But they'd be looking for a 10% yield plus. And
probably
yeah. And I said to him, I said, the other thing that you could do is you could sell off the resi and keep the commercial. You could sell it off. The parts of the whole are worth the parts of it are worth more than the whole. You could sell the 1 and 2 beds off, and you could probably clear down the mortgage on this property and one on the other. But you'd have to keep the other one mortgage. But at least you'll still have some cash flow in from this, cash flow from the unleveraged property, and some cash flow from the property that is leveraged. It won't give you what you want, but you won't feel like you're underselling a big asset of yours. So we'll see. I'm going to follow up in the start of December.
I hope he paid handsomely for that quality consultation, because that's very good stuff. Very good stuff. But
unfortunately, in our world, if you're trying to secure an asset to take to auction, this advice is free.
I figured you were going to say that. It's a shame, but I mean, that's that I have seen buckets of similar stuff, and exactly the same. People think this mythical. I usually like look out the window looking for the mythical unicorn cash buyer that's going past, who's got millions of pounds in the bank, but is also really stupid. And it's surprisingly they're not out there. You know, it's like.
I was talking to somebody else as well. It's not a very relevant story. Need to sell a residential property fairly quickly. We're looking at auction. Have some time pressure in getting it done, and said, "Oh, you know, I'll reach out to a couple of cash buyers." I said, "Well, you can, but you know, they're not going to offer you anywhere. They're going to offer you the price, and then you'll see your property go to auction and sell for 50 grand more." I said, "There's nothing wrong with that, but you know." You have to pick your poison. You're not going to win everything. It's not a case of having your cake and eat it. You can have your cake and eat it, but you have to go for a 30-minute mile, a 30-minute run afterwards to gain some balance. But there does seem to be this expectation, an unrealistic expectation from people.
And usually that comes from just people not ever having the experience of dealing with cash buyers or auctions or something else. They just have that.
Or even bigger, not ever having to sell an asset before. You see there's a lot of networking events. You have people that attend that go, no, we're buying to never sell. We're never going to have to pay the capital gains, right? We don't want that bill. We're never ever going to sell. So you have all of
Good
these.
plan. Should be fine. Should be fine.
Yeah, perfect. But the problem with that is you find that a lot of landlords have a really good method of negotiation on purchase, but they're absolute toddlers when it comes to skills for selling. They haven't got they fumble and they fobble and they fuck it up more often than not, and it's horrendous.
Let me say just one quick thing because it's really pertinent to this. I'm dealing with a client right now, a lovely family from nearby here in Southend. And over the years, they've accumulated a lot of investment property. They got the main property plus 15 properties. They're now 68, both of them. They got loads of assets. They don't have a penny to their name. They never even thought about inheritance tax. And I told them, look, you're about 2 million in assets, taking away all the debt. That's about 400 grand in IHT right there. Oh, really? I never really thought of that. But then he said, do you understand that until your kids pay the 400 grand of IHT, they cannot touch anything? I mean, nothing will happen to the estate until 400,000 in cash is put on the table. And that was like a wake-up call, but they're 68, they're not 22, they're 68. So just to say, accumulating was great and they did really great, but now they need, somebody to tell them what needs to win, to hold their hand and to look after them because they don't have the skill set, which is what we
I think it's a great point. I upset people on a daily basis, but I upset someone the other month because big portfolio to sell, really sensible, great conversation. Guy with his finance director, who was a commercial banker with one of the decent sized banks. Easy to deal with. Great conversation. But then it's like, right, have you got the means and the wherewithal to do the deal? I'm like, sure I have. But the thing is, whatever I put in is going to have to get a return. I mean, you do get that, right? I'm not just going to buy it for the sake of it. We were talking around about a 15% discount because that's where he wanted to be. That's what he could justify walking away. Sure, purely from an ego perspective, really. I mean, of course, the money was nice, but we were talking into the 8 figures here. So it wasn't like it was the marginal million is not going to make a difference, right, to him ultimately. Yeah. And I just said, the thing is, so I will go away and do the figures on this. And the way I deal with it, I'm open book, right? I'll show you the figures exactly as they are. And I'm looking for a reasonable return on any money that I leave behind in the asset. And we can go through all the creative strategies that you want in the world. But ultimately, if I've got to leave money behind, I'm not going to be leaving it behind for the sake of, where's the return? Hey, Abby, where's the return? If the return's not there, I'm not going to be able to do the deal. And that's the bottom line. And people are not good at putting themselves in somebody else's shoes. And I think that's one of the things over the years that's given me an edge as a negotiator, because I'm almost too good at putting myself in other people's shoes, and I want to help and I want to look after them and I want to be fair. And that works with some people. With some people, they'll do what that guy probably did to Jay and abuse the free consultation and then go, oh, thanks very much. I'll chop that up and do the title split and flog them off now. Brilliant. Thanks, mate. Well done. Thanks for the solution.
Yeah. Oh, well. There was something you wanted to share with us, Gianpaolo?
Yes, there was.
Approaching the end of the session, so like gone on 5 minutes or so.
There was. I'll show you just quickly. How do I share a screen here? Have I got the option to?
Yeah. I think you tried that before. That is this present button.
Okay.
In the middle.
Help me out, Piotr. What do I press? Where do I go?
At the bottom, there's a present
button.
button.
Present. Yeah. Okay.
And then you can choose what you want to present.
Yeah. Okay. Do it right now. Sorry, I wasn't prepared for this. So share screen, and we go.
I had many people, Gianpaolo, who were. I've been in many conversations with vendors of a similar sort of age of the people you were talking about, with the same tax planning lack of so many. It really resonated. So, but anyway, over to you.
I just want to bring to everybody's attention something that came across in the FT about 2 weeks ago. We all know that in the last few years, up until about 2 years ago, interest rates, long-term interest rates, have been going down and down and down and down. These had, as a consequence, that all these companies which had final salary scheme, the bulk of the liability kept getting bigger and bigger and bigger. So if you have to secure to somebody the payment of £20,000 per annum, and the long-term yield keep going from 5%, 4% to 3% to 2% or lower, the amount of money that you need to set aside in order to satisfy the liability keeps getting bigger and bigger. Now, this is what happened. If you look here, in those here, the line starts much before, but that's what happened up to 2021, towards the end of 2021. I don't know if you remember, but when there was the negotiation about the Talbot port between Tata Steel and the government, the Indians said, we need the government to help and bail us out. And it wasn't about the ordinary operation. It was about the size of their pension book, because they were unable to put all the money away needed for the liability. This is a story that is happening over and over and over again. Now, there's been no conversation about this in the last 2 years until I saw this article 10 days ago on the Sunday Times, on the Financial Times, when they say, well, with the sharp increase of yield in the last couple of years, dictated by disruption of the supply chain, by Russia invading Ukraine, by inflation waking up and going mad everywhere, long-term yields, and we've all heard this, have gone up a lot. And the consequence of this on the final salary pension is this. If you look at this chart, at the very highest point, these are the figures that apply for somebody of a certain age who is due a yearly payment of £10,000. The value needed to secure the payment was up to £270,000. Okay, this is somebody of a certain age. I don't have the specifics here with me, but with the due adjustment applies to everybody. Look what happened throughout the 2022 with all that happened with inflation. This mega negative spike here is Liz Truss and Kwasi Kwarteng did their very best to mess it all up. Incredible job. And you cannot even see it here, but the counter spike that happened in those days, the Bank of England intervened. You can see that we dropped all the way to the bottom. We bounced back up, then we back down again because spiking. That's when the Bank of England bought billions, trillions, a huge amount of gilts. They stepped in on the Monday. You will remember cable, so pound against the dollar printed 103 the Monday morning. Okay, Bank of England came in and they bought as much gilt as they could. So they kind of stabilize things in the long term. But ultimately, we're looking at a scenario in which long-term yields are higher. So when you look at this chart, it means that somebody with a final salary pension can be satisfied with these needs of getting the £10,000 per annum with a sum of money which in the region of £160,000 a year, no longer 270,000. So this means that all those companies that still have final salary schemes don't have a liability the size of that, but they have a liability the size of this. So after all the moaning that we have for 15 years about, we cannot afford this pension anymore, nobody's been saying, but all private companies which have DB schemes now are sitting in a much better position. I would also like to give the other perspective though. So if you are the owner of a final salary scheme, you may say, oh, rubbish, I wish I could have sold it here. I could have transferred out there because I would have been paid a lot of money. And if I transfer now, I only get this amount. That is strictly true in monetary terms. But the other side of the equation of this is that during this movement, annuity rates have literally exploded. All the annuity providers, and there are lots of them, but they basically be doing nothing between 2008 and 2021, are now scrambling to hire people, to up their resource, to improve the product. We as IFA have never done this much business in annuities for people. And annuities are not boring, predictable things anymore. There are various variety, there are fixed terms, there are guaranteed at the exit. Really, really good. So just to say, if you are the owner of a final salary scheme, yes, you have been hit by the fact that the value of your pot has gone down a lot. But the amount of stream of yearly revenue that you can buy with the reduced pot, you know what, is not far off at all what you have gotten at the top. So this is for the individual perspective, but I just wanted to paint the corporate perspective because obviously bad news always make the first page and good news never does. So I just wanted to bring it and share with you.
Super.
Okay,
Nice.
and that's it.
Nice. That sounds rather positive. And in terms of like the good impact of those companies, I mean, does it impact on the like liabilities and the balance sheets, or is that where does it impact the companies?
The best part for the companies is that where they would be used to put away, I don't know, probably 5% of turnover to top up the pension pot because they had to, just to keep up. And very often, even the 5% or 7% was not enough to top it up, and they were running deficit. You know, BT had a massive deficit, BA had a massive deficit, most companies had a deficit because you couldn't cope with 20 years rate, 30 years rate, starting with a 1 or starting with a 0 even at times. Now the picture is completely changed. You got all that spare cash that doesn't need to go into the pension pot because the pension pot is fine where it is. And at the moment, nobody knows whether the third-year gilt is going to go back to what we've seen for years and years, or whether this is the new normal. So there is no reason to put money away. So the money can be put now into investment. We know there's an issue with productivity in this country. We know we underinvest. So together with what Adam was saying, you know, great way of make use of the super allowance and to get all that deducted for your tax bill. UK corporate has a massive opportunity now. For once, you know, they're a little bit in luck, and if they use all that the government has put in place together with these changes scenery, there could be some really good few years ahead. So yeah, bit of positive news.
Yeah. So companies that only need to put away those money when someone is retiring, or do they need to be putting this money all the time into the scheme? Can they choose, for example, oh, now it's only costs 150,000 to buy this, like basically pay for this pension? Can they like buy more of it right now?
Companies with these schemes know exactly how much the actuarians tell them their liability is. Let's say it is 3 billion. They should have funds on the side ready to match these 3 billions. For years and years, we were in a situation of deficit. Now we're in a situation of surplus. So they cannot really influence long-term rates. What they can do is obviously invest some of the cash at 5%, maybe for 20 years, so they kind of offset a portion of the liability. But the best way, a company, unfortunately, in these years, it has become the norm. The successful company makes so much cash they find it difficult to find ways to invest organically within themselves. We're seeing a lot of M&A activity, more in the US than in the UK, but we're also seeing a lot of buybacks of shares. Now, buyback, by all means, is a great way of giving money back to the investor. Buyback is when a company says, we got all this cash, we got no idea how to make it as hard as we have in the past. The fairest thing to do, we'll give you the money back, which is fair. But you also would like to see the company say, we got all this cash, we got a million ideas of how to make more cash in the future. But that is a tall order. So, it could all be conducive for the near future.
Imagine for some of the companies that you've mentioned and some of the big old corporates that make up the FTSE, the FTSE 100 or whatever, ultimately, if you're someone like BP at the moment, it's difficult to have projects with big net present value that you can put that money into, because you can put it into net zero, but there's not necessarily profitable schemes for you to be getting involved in, and there isn't government money to subsidize all of the schemes that you might want them to go into. So that's always the way, and buybacks have been the plague of the quantitative easing era, really, and this all feeds back into the underinvestment perspective, because instead of investment, it's buybacks, because we haven't got anything else to do with the money. That the buybacks before were based on such cheap debt that our returns on equity are being fluffed by the cheap debt. Now we can afford it because we're running surpluses. But I said it some time back, with a 30-year gilt of 5.15%, which it was a couple of months back, when I did one of Rod's investment mastermind recordings. I said, it's just fabulous value. If I ran a pension fund, I'd be going in, ploughing into the 30-year gilt and say to everyone, right, I'll see you in 25 years. Nice knowing you guys. Thanks a lot. Everybody's sacked pretty much, apart from the processors. So it's helpful, but it's the speed of the transition. A bit like what you were saying with the the annuities and everything else and the providers. The speed of the transition is quite difficult for people to cope with, because all of a sudden, when you haven't had any movers and shakers in that space for 15 years, you need to hire a load of talented people in order to innovate with the products, as you were saying. And there's a transitionary period, like there is with all of these things, that's a bit sticky, really. Sometimes it's not very efficient.
And while we're talking about long-term gilt, just a little nugget of wisdom. Keep in mind that in the UK tax system, if for your normal money, so forget about pension, if you own a gilt, you will pay income tax on the coupon, but you wouldn't pay capital gain tax if you buy a gilt at 70 and then you hold it all the way to expiry to 100. Okay, you don't pay capital gain tax on the gilt. There are so many gilts that have been issued in the last 5-6 years, which have got incredibly low coupon. I'm talking about 1% or less. So for anybody that, for example, is selling £1 million worth of property and is wondering, what should I do with the future, with the money that come in? Keep in mind that if you buy one of these very, very low coupon gilts, you will pay tax. You will pay tax on those tiny coupons. But if you're buying a 30-year gilt with a 1% coupon at a 5% yield, you're probably going to pay about 60, 65. And on that 35 to 40 points of appreciation, capital gain is zero. So just another tool in your planning. What do I do when I got all that money? Okay.
It's a fabulous point. There are actually 37 gilts that were issued over the super low period with a coupon of 1/8%. They weren't a 30-year duration, but your point is absolutely valid, and people should absolutely take, especially in the tax regime that we're in at the moment. To avoid any tax legitimately is a great idea. If you need liquidity, it can be somewhat problematic, but it's such a valid point. And risk-wise, should be fine. Should be fine. I hope so. Otherwise, we're all in trouble.
Amazing. Well, we reached an hour, just over an hour, but it was a great discussion. Lots of points covered. I'm pretty sure at least a couple of books could be written on the concepts covered in this book, in this chat. So brilliant. Thanks, GP, for joining us and sharing your wisdom. And Adam, Jay, thanks for the comments and everyone else who watched and commented and not commented as well. See you all guys
Thanks,
next week.
Gianpaolo. That was great. Cheers. Thanks a lot.